the ones where they run things. Behind the scene, they know they see you. You they walk, you they try, you they make sure say everything go they okay. So I live with you. We say Oluwa no go shame you. Oh, share la people hello. Amaluabi share o tu baraka. You're doing well, oh my brother. Oh, share la people hello. Amaluabi share o tu baraka. You're doing well, oh my sister. Oh, share la people hello.
On a bed de fou. On a there. Il gèle. I am for the other follow. Moi, I take it, because of them the cash up front before take it for personal. You have Okubane going to take it very personal.
Jump life, celebrate life.
Thank you for joining us for our conference call to share the 2021 full year result for Nigerian Breweries PLC. We are actually live from Abuja, where we have spent the past 2 days at our commercial conference with our sales and marketing teams. We are very pleased that you are all able to join us today. 2021 was another eventful year for many businesses across the world, headlined for us by the proud attainment of our 75th year anniversary. We are keen to take your questions and your comments about our company's performance, and therefore kindly request that you make use of the Q&A option in the virtual panel for the virtual meeting, and please post your questions there. In posting your questions, please include your name, organization, and our team will do their very best to answer as many of the questions as possible. At this point, I would like to introduce our presenters. I have here with me Hans Esadi, our Managing Director, and our Finance Director, Rob Clenyon. They will both be taking you through our results and performance in 2021. I welcome you all and now kindly invite Hans to open the 2021 full year results presentation. Thank you.
Thank you, Sade, and good day, everyone. Let me start by sharing a little bit of the history of Nigerian breweries, especially for the benefit of participants that are joining us for the first time. Nigerian breweries has a very proud history and heritage. And as you can see on the picture, we are and celebrated on the 16th of November 2021, our 75th anniversary. We did this with various internal and external events, which spread over a 1-year period. We are celebrating the success and the legacy of Nigerian breweries. We actually started operations in Lagos in 1946, and our relationship, our partnership with Heineken also dates back to that same year. We are the first and proudly so brewer in Nigeria, and we have become and remained market leader since. As we speak, as of now, we have a portfolio across the different segments in malt, beer, soft drinks, and beyond of 19 brands in our total portfolio. Just a quick word on COVID-19. Also to protect our people, we have adopted during the period a cautious approach to protect and safeguard the great people of Nigerian breweries. And we're also positive about the short and midterm future, that we see the number of COVID-19 cases going down significantly. Just celebrate. Excuse me. Apologies. So we're changing gear from the 75th anniversary to some of the macroeconomic outlook, and it's clear that we continue to see challenges, and there are foreign exchange challenges, pressure we've seen on economic growth, that in the last quarters we are seeing some modest growth in the formal economy. And as you will know, the formal economy is less than 50% of the total economy in Nigeria. And we've seen also in that informal market a relatively big surge in demand. Now, if we look at the graphs, then we will see that the annual headline inflation is coming down, albeit still at relatively high levels. We see the official rate, the CBN rate of the dollar versus the naira, being very significantly below black market rates, causing issues for our business, where we are only able to officially get a minimal amount of the foreign exchange requirements that we have, and is something that in our treasury department, and also together with our major shareholder Heineken, we are trying to work on to make sure that we can continue to safeguard the supply in the Nigerian beer market. If we then have a quick look at our portfolio, starting with premium, we have had a fantastic year 2021 with our premium brands. We've had the courage that beyond Heineken, a very established leading premium brand in the market, we have ventured with the Tiger brand into more premium offerings, and yeah, that is and has been very successful for us, with campaigns, international campaigns on the Heineken brand, with James Bond as an example, but also the Uncaged campaign around Tiger that is resonating very well with Nigerian consumers across the country. If we now move to a mainstream lager, where indeed the real battleground is for the beer industry, we have done extremely well with both our Goldberg brand in the west and our Life brand in the east, exciting consumers, but also very much connecting with consumers in the various regions in the east and the west, with campaigns, localized campaigns, regionalized campaigns that are getting more and more traction, and it is also our intent moving forward to not only continue but also to further increase that resonance for our brands in mainstream. If we then move to beyond beer, historically we have seen with our malt propositions and our stout propositions, Maltina, Amstel, Malta, and Legend In Stout, we have built fantastic brands and market positions, but we're adding now also on the basis of consumer research on changes in demand that we see. New consumers coming into the categories, Gen Y, Gen Z, but also towards more female consumers, adding brands like Desperados, a flavored lager beer, so flavored with tequila. And Gulder, we're venturing into craft and really trying to excite Nigerian consumers across different flavor profiles, but also across different price points. From our brands and our fantastic brand portfolio, a few comments on our Brew a Better World initiatives and commitments in 2021, where we are raising the bar on environmental, social, and responsible actions. And let me mention a few of them. The Ibadan solar project that we are extremely proud of, really using solar power as an integral part of our way forward and also reducing our footprint. The Maltina Teacher of the Year initiative that has been going on for a number of years and is receiving lots of positive, not only from teachers themselves, but also from government stakeholders, positive comments on the way that we, over the course of a year and then culminating in the major event at the end of the year or the beginning of the year after with an award show, but really trying to get capability levels of our teachers to a higher level. And then maybe thirdly, and not maybe, but definitely the Recycle project that also there we're trying across the industry in the FBRA together with other fast-moving consumer goods company to really reduce the plastic footprint in Nigeria, and we're there also accelerating our initiatives that we are very proud of. Thank you. Rob.
So thank you, Hans. Let me give you some highlights of our performance in 2021. So let's move to the next slide. On the next slide, you will see the income statement for the full year. We can see here that the impact of our price increases and portfolio prioritization in our top line is coming through. Our revenue has grown more than 30% versus last year. This growth distributed in all the elements of the revenue line, so it's both driven by volume, by price, and by mix. As I mentioned in the last call that we had in November, where we showed the Q3 results, at that moment you could not yet see the impact of the price increases that we have announced late Q3 and in Q4 2020. But you can now see clearly in Q4 the significant growth of our revenue line. Then moving down in the income statement, even when you compare to Q4 last year, where we sold more volumes coming out of the pandemic, we had also higher stock levels at that moment due to the demand in Q2 and Q3 in 2020. Overall, we had a volume growth year on year, but if we compare Q4 alone, the volume of last year was higher due to the stocks built up during the pandemic in Q2 and Q3. Our cost of goods sold have increased primarily driven by raw materials and packaging material prices, both impacted by inflation and FX devaluation impacts. For example, on sorghum and sugar prices, but for example, also on the prices of our cans. However, we have managed to mitigate this impact with our cost and value agenda, minimizing the impact of these trends on the input cost. If we then move to the next slide, I will show you a more detailed bridge of the impact of those costs versus inflation and revenue developments. On this slide, I want to share a little bit more color on our revenue and cost per hectoliter evolution. Since mid-2020, we have seen a clear increased demand in Nigeria coming out of the pandemic. If you remember from our full year 2020 results call, the second half of 2020 were record-breaking, and at that moment saw the opportunity to recover part of the overall profitability of the business. Late 2020, we started to focus on the optimization of our discounts and promotion schemes. In 2021, we were able to pass price increases on to mitigate the gap that was created in the evolution of our cost per hectoliter and our revenue per hectoliter over the last 4 years, as you can see in the graph on the screen. If you look at earlier years, we even had a negative impact due to the impact of the, for example, the excise duty increase over the last few years. The cost depicted here is the variable cost by nature, coming mainly due to the commodities and devaluation effects. This has no impact on the fixed costs such as salary, depreciation, etc. Main focus here is on the raw materials, packaging materials, and distribution costs. And as you can see, we are still significantly below the evolution of the general consumer price index with the price increases that we have passed on in 2021 and also now early 2022. If we then move to the next slide. On this slide, I would like to give a bit more flavor on the build-up of our results. We are presenting here the bridge by nature of expense. This is easier probably for everybody to follow. You can also find this information in detail in our financial statements. On the cost and expense side, the increase is mainly driven by raw and packaging materials. As we mentioned in the last call, marketing and sales costs were higher than in 2020, when we had a very low level of activities in this category due to COVID-19. Employee benefits are mainly driven by the yearly CLA increases, but also by higher bonuses payout for the year 2021 due to our results development. If you recall, in 2020, we had reduced the bonuses and incentives payouts significantly. We already mentioned the redundancy cost on the last call in November, but I'm referring to it here again, since it is a one-off in 2021, which we have captured the benefits already partially in the second half of the year 2021, but will continue to capture the full benefit of it during 2022. The positive impact of the lease and right of use of the derecognition of asset is linked to a change in contract terms with some of our transportation suppliers. If you might recall, in 2019 and in 2020, we implemented a new operating model with part of our contracted fleet, which was assessed as lease at that moment in time, and brought into our balance sheet in 2019. In 2021, however, part of the terms of these contracts were renegotiated due to operational reasons, and that led to the reassessment of assets previously classified as leases. The impact of this derecognition on lease liabilities and right of use of assets has led to a one-off impact of 2.9 billion, which is caused by the difference between the lease liability and the right of use of itself. In 2020 and 2021, we also had a higher interest from leases, as the recognition implies a front load of interest expenses. So this corrects the early recognition as well. On the other hand, the derecognition also had an impact on the deferred tax assets, which we will cover in more details on the next slide. So can we move to the next slide, please? On this slide, I would like to focus on the development of the net profit. I have already mentioned the key highlights on the operating profit on the previous slide. So here is the focus on net profit. The other side of the impact of the derecognition of the lease trucks is that we had also to reduce our deferred tax liability. Since this temporary difference will no longer materialize, we had to revert the previous recognized impact. This has led to a higher than normal effective tax rate for the Q4, which will normalize going forward back to the normal level. Our interest costs have reduced mainly due to the lower level of borrowings, but as well as the impact of actuarial costs. We can also see the impact that the scarcity of foreign expenses have brought in the accumulation of foreign payables to suppliers. We see a bigger impact here on our net profit coming from that. Hence, we will continue to search for alternatives and solutions to reduce the balance of foreign payables as much as possible going forward. If we then move to the next slide, the balance sheet. As you can see, we remain with a very strong balance sheet. I would like to draw the attention to some of the highlights of our financial position versus the same period last year. I start from the top. On right of use of assets, you see the total, most of the impact coming from the derecognition that I have already explained on the previous two slides. You also see the impact on this in the line borrowings down in the liability side of the balance sheet. Part of the reduction in borrowings comes from the lease liabilities derecognition, but another part comes from a lower level of debt, about 50% split between these two items. You can also find these details back in the disclosures of our financial statements. We continue with our big cross-functional task force for cash management, both on maximizing the cash collection as well as managing our payments, which you see also coming back in the development of our balance sheet. If I then focus on the receivables, you can see the big impact from the optimization of our cash-based promotions. Further engagement with our distributors and focus have significantly reduced our receivable position. We have a high number of prepaid orders, which for disclosure purposes are classified to accounts payables. The increase on trade and other receivables here are mainly driven by some prepayment advances to strategic suppliers in order to ensure supply. The impact of these advances in Q4 are about 17 billion, and they are normally recovered within a 3-month period. On the payable part, we have focused on optimizing, but always within the principle that our whole supply chain needs to remain healthy. So that includes also our suppliers. So we pay always on time for our priority materials and in certain cases support our suppliers with advances, but also with solutions like supplier finance. We also have partially increased due to the scarcity of the FX, which has decreased our ability to pay our foreign payables. As I have mentioned, the prepaid are also included in this line as credit balances from customers. A big impact on our accounts payable was the timing of the plant and machinery for our AMA brewery expansion and other capex items that were acquired or delivered in December 2021, which has inflated our payables disproportionately. We will see more of the next slide on cash flow. On inventories, we have two main movements, basically a lower stock of finished products compared to last year, where we had higher pre-stocking strategy than we could do this year. And secondly, we have seen a higher lead time for supply of goods. So the supply chain of delivering from the source to us has been extended. Hence, we had increased the safety stock levels to ensure production, and as we have seen the impact of inflation and Naira devaluations as well. If we then move to the next slide, our cash flow. I have already highlighted the key changes in our balance sheet, which also reflect here on the cash flow. The key additional highlights here are the level of capex on investing activities. As you remember, we have optimized our capital investments in 2022. The other highlight is our cash and cash equivalent levels, where in 2020 we had a higher safety level of cash, and we also closed at a higher balance in December, as we had to settle our commercial papers early January 2021. We have optimized the cash levels, also reducing our borrowings at the same time, and this strategy we will continue during 2022. In 2021, we have continued to scrutinize our investments in a very thorough manner. You can also see that we have in Q4 the majority of the impact of the AMA brewery expansion. As you can see in our financial statement, our commitment levels have grown back again in 2021, mainly driven by returnable packaging materials and capacity expansion. If I now move to the next slide, which is our proposed dividend. For 2021, the board of directors kept a ratio of 100% dividend payout, which again shows our confidence in our balance sheet and our appreciation for the shareholders' interest. The dividends will be paid in cash or in shares, which the shareholder may choose. We have given this option as it gives the shareholders the option to increase their participations, helps a higher market capitalization, and from the company side, it may release some pressure of borrowing needs in 2022 as well. The proposal is, of course, subject of approval by the shareholders of the AGM. And with that, I would like to give the word back to Hans for the outlook for 2022.
Thank you, Rob. And thanks for sharing these strong results for 2021. If we look into 2022, then it remains clear that the fundamentals of the Nigerian beer market remain where they are, with a young population, a fast-growing population, increased urbanization. We see high growth potential for years to come, and we believe also on the basis of our revenue management, so the right pricing strategy coupled with cost management, strict cost management, that we'll be able to maintain our leadership and drive /increase, improve profitability. It is also clear that country volatility remains a high risk. Security, infrastructure, to name a few, will continue to pose issues and challenges for operation. We just want to make a mention of the excise duty that has been introduced and will be formally implemented on the 1st of April on non-alcoholic drinks, which we aim to pass on to our consumers as and when this becomes official. It is also a pre-election year into Q1 2023, which we believe we will see some increased spend as a result of activities surrounding the pre-election. Overall, we believe we have the history, legacy, the national footprint, but also the proud brand portfolio across the various segments and price points that will enable us to capture growth, expected growth in Nigeria. As Rob mentioned, we aim to complete our capacity extension in the east, which will enable us to better meet customer and consumer demands across the country. And as we have been over the last 75 years, we are committed to Nigeria, and we are committed to long-term value creation for our shareholders, and believe we have the right strategies also in place to achieve this. Thank you very much.
Thank you very much, Hans and Rob, for taking us through a very well-delivered presentation. We will now move to the Q&A session, which we will take for the next 50 minutes. The floor is open, or literally the line is open for your questions. Please remember to put in your name and your organization so that will aid the answer. And I will move directly to the first question, which are for Hans. So Hans, we have a question from Taj Ibrahim, and he has asked, first of all, And I will join the two questions if you don't mind.
Please.
So his first question is, can you speak to the capacity expansion going on right now? And his second question is, what is your plan on the 10 naira per litre tax on soft drinks?
Thank you for the question, first of all. And let me, and I think I just spoke on the excise increase. We do see excise tax as a consumer tax that, you know, as and when it happens, we will pass on, and we will do this as transparently as we can, following the as we speak 10 naira per litre increase on soft drinks, and whatever increases in excise will follow. As to capacity extension, both Rob and I alluded to AMA, the extension in the east, which will give us additional capacity to meet, as I also mentioned in the outlook for 2022, the increased demand that we see. This extension is also testament of the long-term journey and the sustainable way with which we approach Nigeria. We are here in this market to stay, and we're building capacity ahead of the curve to make sure that we can also, moving forward, continue to meet customer and consumer demand. Thank you.
Thank you very much, Hon. I will now move to the next set of questions, which are from Abdul Rauf Aremu Bello. And I will direct, he has put in, Rob, about 7 questions. I will take the first 4 to you because I can group them together. So first, he has asked, can you please give a breakdown of the percentage contribution of price, volume, and mix to total revenue growth? That's the first question, and I will just put in the second question. What is the company's policy or response to rising global commodity prices? And I'll leave you to answer those 2 first.
Okay, thank you, Sade. Let's start with the first one. So if you look at the development of our revenue line, there are indeed several elements that play a role there. It is indeed the price increases that we have done. So we have done price increases last year. The first one we did in March, then there was one in summer, then we did another one in September, and then the last one we announced, I think, late October. In the way that we work, there's also then a lead time in the implementation, because the orders that are already in the pipeline are respected as they are. So price plays an important role. The other one is, of course, volume. I can combine that part also with your second part of the question about coming back to what Hans said, is the reason that we expand our capacity is that we see a clear development of the demand in the market, and that in order to stay with that demand, we need to expand our capacity to stay available for our consumers in the market. So the last part that's playing an element in the revenue development is the mix. So we have a clear strategy where we focus on the optimization of the mix of our products, where we every time look at the margins depending on the development of the commodity prices and the commodity prices were very often also the reason to come with price increases to transfer that further to the consumer. The last one is we have in the past we had a promotional schemes in place with our distributors. This we stopped, which is also a way to further manage your price in the market, because it from a brewery perspective it optimizes the ex-brewery revenues. I hope that answers the first question. I cannot go further detail in the breakdown of the different elements of your question, but I think I made clear which elements are there and how they have an impact on our revenue development. The second question of you, that is the one on the commodities. The commodity price development is indeed a significant issue for any business at this moment, not only in Nigeria. If you, what we are doing here is we have a sort of twofold strategy. One is we want to capture in longer term, so medium, so let's say minimal 1 year term contracts, the needs of quantities that we need at given prices that we agreed. And on the other side, we want to optimize what we can produce or what we can acquire locally from local sources to reduce our dependency on FX availability. In the mix of the two, we have for 2022 quite a secured base already, or we have a good insight in the base for our costs for the year 2022. We have also quite a secure view in the availability of the different raw and pack materials that we need in producing our goods. Shade, back to you.
Thank you very much, Rob. I'll quickly ask you the next two questions from Abdul Rauf. His third question is, the company made a significant capex in 2021. Given the weak growth in the industry for obvious reasons, what is the idea behind the massive investment? Do you run the risk of over-investing? And I'll add his second question. Marketing and administrative expenses rose materially in 2021. Do we look at the sharp rise as a one-off, or do we expect a sustained trend, especially on the marketing spend? Is that okay, Rob?
Okay.
Two questions.
Next two. So the first one of that is the capex investment that we are doing in 2021. We already mentioned several times that the AMA expansion, which is a capacity expansion of one of our sites, has an impact on the capex. Part of that materializes as work in progress during 2021, but the project will be delivered late Q2, early Q3 in 2022. So the capacity that is then built will be available by mid-year, roughly. Having said that, and coming back to your question, the reason that we invest is that we see a clear growth in the market. And we also see our production capacity that is available. So we don't see the risk of over-investing. I think what we are in line with the curve of the demand, and we expect that the capacity expansions that we are, let's say, making effective now will enable us to capture a fair share of the market growth in the coming periods. If I go to the next one on the marketing and administrative expenses, yes, you are right. They have risen significantly versus 2020. 2020 was the year where we put a clear break on all our spend, and we wanted to write out first the effects and assess the effects of the pandemic as was then taking place. From that perspective, the spend in 2020 was quite low. I think if you want to look at comparables, you better also look at the years before 2020 to get a better insight in how they are really developing. In general, it is very clear that in the business where we are in, it is very important to keep on investing in our brands. And in order to invest in our, and to do that, we put significant money behind marketing, because in the end, the marketing also reaches to the consumers, and that is what also sells our products. So our investments in marketing will continue going forward. Shade, back to you.
Thank you very much, Rob. So we will move to question 5, still by Rauf, and I'll give you a bit of a break now, Rob, and this question will go to Hans. So for question 5, Hans, Abdul Rauf is asking, how would you evaluate your market share and competition in the malt segment? He's also asked, in addition, how would the company respond to the recent sugar tax? But you've already addressed that, so you don't have to answer that part of the question. And there's a second question, but I'll let you answer this first.
This was specific to malt.
Yes, so how would you evaluate your market share and competition in the malt segment?
Now, first of all, it's clear that malt is again a growing segment in the Nigerian market, which for us is the good news. We have invested significantly behind the 2 flagship brands we have in our malt portfolio, Maltina and Amstel Malta. And we are clearly seeing the results from that. Moving forward, also looking at the footprint in Nigeria, we believe there is, especially in the northern region, even more opportunity to grow our malt portfolio. I hope that answers the question.
Thank you, Hans. Yes, that does. And I will move to Abdul's next question for you, Hans.
Okay.
Number 8. In previous communications, the company stated its 3 broad strategies to win, including driving premium growth and 2 other strategies. I would like to please ask how you measure progress on each of these strategies.
On premium growth specifically, Shadeen.
Yes.
Sorry, because my video was...
That's fine. In previous communications, the company stated its 3 broad strategies to win, including driving premium growth.
Yes.
And 2 other strategies. I would like to understand how we measure, he wants to understand how we measure progress on each of the strategies.
Yeah, there's multiple angles to this. The way we look primarily at this is through research, so consumer research that we capture in what we call a brand power score. So we look at the equity of our brands, and it is clear with a premium portfolio that we need to be able to fuel our brands, starting with the Heineken brand, which is one of the leading brands, if not the leading brand in the premium segment. Is, are we capturing and are we engaging and exciting consumers to the point of that premium price point? And from what we know, other than the brand power, is also the resonance, and that in more and more areas across Nigeria, also away from urban areas, that our premium portfolio gets adopted more and more, and there a measure is distribution. So we see an increase in our distribution, so our net numeric distribution, and how many outlets are we selling premium, that also is up significantly. So that's a few elements of why we believe our premium strategy is working.
Thank you very much, Hans. So I will move to the next set of questions, and try to finish off all Abdul's questions with you, Rob. Okay. So, number 6, the company's payables have grown materially. What was the driver? And I'm going to add in 7. I observed a significant rise in your goods in transit component of inventory. What was the driver of that? Was it the logistics? Was it due to logistics related?
Okay, thank you. So if you first look at the payable part, there are several elements that play a role here. So one of them is that, as you might know, for the purchases abroad, we work with a sister company. Via that sister company, we are sourced, for example, for malt. And since access to dollars is in the last 2 years difficult, it also means that our payables denominated in foreign currencies has been growing. So that is part of the answer. The other part of the answer is that what I mentioned in my presentation was that in our financial statement, we have to report prepayments, pre-funding from our customers as part of the payables. And we did it already like that, because then also the amount was significant. We did it in 2020, and now in 2021, it happens to the same level even more. So that also refers to that it ends up in the payable part. The third element is, of course, the AMA expansion. Is the fact that this is a project that will go live in July, roughly. That means that the lead time between the moment that we started the project and the moment that it is effective is more than 12 months. From roughly October till March, April, elements of the construction for the site are delivered, And during this period, and especially late December, some major components were delivered. They had an impact on the size of the payables as well. So I believe that answers that part of your question. The next part of your question was about the growth in goods in transit. So also there are a few elements that are important. The first one is indeed we recognize clearly that the transit in of products from abroad is getting longer. It gets longer from the availability at the suppliers itself, all driven by, let's say, carry-on effects from the COVID pandemic. The second part is linked to the availability of ships to bring them to Nigeria, and the third part is getting them from the harbors to our sites, where also the, let's say, the congestion in the infrastructure in Nigeria has an impact. So overall, that leads to the approach where we have the strategy that we want to load more stocks into our structure. So, for example, late December, we shipped quite some malt to Nigeria. The reason that we did that, and the moment that it is free on board, it is our responsibility, and it appears in our goods in transit. The reason to do that is that it is very clear that if we have a good stock position, we get less dependent on fluctuations on the transport routes into Nigeria. So it is part of our strategy to make sure that we have higher stock positions, to make sure that we don't have any impact on our production capacity. Because that's the worst thing that can happen, is that you cannot produce due to lack of materials. And if you look back to 2021 and 2020, I think we did really, really good there. Thanks, Shelley.
Thank you very much, Rob. I will ask the final two questions from Abdul Rauf, and because we have just 21 minutes left, we need to take these briskly. The first question, number 9, is what is the outlook of pricing in 2022? And lastly, number 10, how is the company deploying the use of technology and or e-commerce in pushing sales? You can take the first one, and I will invite Hans to take the second one on e-commerce. Thank you.
So I will be quick. So in 2022, we have now announced 2 price increases, one in January and one earlier this week. They were driven by input cost. So those are clear, they are communicated to the market, so that those are known. Looking forward, it is obvious that that's making announcement about what might happen in the future is impossible. It is in the end fully dependent also on the further development and increase of input cost. So if it is needed to secure our profitability of the company, we might go back to price increases if the market can also, let's say, absorb them. So we have to play it by the week and by the month, what is happening in the coming year on the price increases. But so far they are not planned to the extent that they have a significant impact. Hans, do you take the other question?
Yeah, the second question was on e-commerce and how do we deploy and how do we also transform our sales operations into this new age of digital. And it's safe to say that we've been on this journey now for quite a number of years. We consider ourselves one of the frontier companies in Nigeria in terms of e-commerce B2B, and our platforms across the nation are being rolled out. We do this phased, and indeed we start in more urban areas, but with the clear intention to digitize the entire B2B operation, including eventually B2C and last mile delivery. So this is an ambitious program that is being developed also partly from the center, from Heineken, so we get their support and also learning and best practices, because it's clear that this is still very much a learning journey in the beer industry, but we are determined to make it a success. And what we see from deployment so far is that our strategies around e-commerce are also starting to bear fruit, that we see in the way we perform and rotation in outlets, engagement with customers, that we are improving our footprint and the way we operate in Nigeria. Thank you.
Thank you very much, Hans. We now have a set of 4 questions from Fola of Stanbic IBTC, and I will address the first 3 to you, Rob. His first question is, regarding deposits for returnable packaging materials, what is your arrangement with retail supermarkets who sell drinks along with the bottles? Do they also make deposits, or would they typically forfeit their deposits? I'll have you take that first question.
Okay, so thanks for this question, Fola. So the situation is so that the returnable bottle is owned by the brewery. So if a bottle doesn't come back to the brewery, we will charge to the customer the cost of the deposit in full. However, how our customers treat deposits versus the consumers is a decision of the customer itself, and we are not part of that decision. So I think if you want more insight in that, you probably have to reach out to the retail. For us, it's important that the bottle is our own, we own it, it is our asset. If it doesn't come back, we charge a deposit to the retailer.
Thank you very much, Rob. I will move swiftly to his second and third questions. Looking at disclosure note 19 on page 17, advances to suppliers increased significantly to 17 billion naira. Please, what drove this increase? And I will also put in a second question to you. What's your borrowing policy relative to the high capex requirement?
Okay, so thanks for these questions. The first one is, let me briefly find it. Where's the question? Hold 1 second. Okay, sorry. So the first one, you read the financial statement pretty good, so compliments on that, because it is somewhere in the small one of the 100 something pages of the financial statement. So the reason that we do prepayments to some of our suppliers is that we have to make sure that our suppliers are able to also remain and sustain the business. Those repayments are captured or covered by a advance payment guarantee, so they are secured from our side, but it enables our supplier to buy the raw and or pack materials that they need to produce those elements that we need. The reason that it went up is that it is very hard sometimes for smaller suppliers compared to us to secure the financials, the liquidity to purchase dollars, probably mostly on the parallel market at higher rates. So that is the reason of the increase. It is the availability of FX to smaller suppliers with which we work, and we want to secure their supply, and by that we support them. The second question, the borrowing policy, is if we look at our cash flow, we have a very healthy cash flow, but we also have a very healthy balance sheet. So if you look at the financing need that we have for the capacity extension, we are convinced and we are sure that we have the financial means in place, or the financing borrowing support that we needed from the banks to secure the availability of the funds to pay to our suppliers. So that, I think, and then I think that's the answer, Shade.
Excellent. Thank you very much, Rob. And I will just take the last question from Fola of Stanbic IBTC for Hans. And his question is, have you taken prices since the increase in January? And did you take price increases in December of last year?
So we've taken no price in December. We did take a price increase in January, and we have just announced on a part of our portfolio a price increase in February. Now, this is a very dynamic process, and we look extensively across our business at, and this is on the basis of the movements in raw and pack materials primarily, but not limited to, on how to adjust pricing in line with market developments. And this is an ongoing process that, as and when, with the utmost caution and also respect for the Nigerian consumer, being faced with the volatility in especially commodities across the globe, we need to take price as and when we believe it's the right time to do so. Just a general comment, but on your specific question, we just took on a limited part of the portfolio pricing this month, and we took also in January on a limited part of our portfolio an increase. Thank you.
Thank you very much, Hans. So we are now going to move to another set of questions which come from Louise Kolaku of EFG Hermes. And his first question is, can you tell us the weight of premium beer in terms of overall beer volumes? I will address this question to you, Hans.
Now, we obviously cannot disclose exact numbers, but what is clear is that across the world of beer and across the world of Heineken, we see premium beer on the rise, and we see that happening at the expense of a mainstream lager. But we also see this, as a sort of an evolution where Gen Z's younger consumers are making quality over quantity decisions in the way they drink and the way they behave. This is broader than only beer or drinks, but that is a phenomenon that we see. And with our strong portfolio of premium brands, we feel we're very well positioned if you want to capture this opportunity.
Thank you very much, Hans. I'll move quickly to his next question. The economy remains under huge pressure, and this again is for you. And inflation is above 15%. You have increased prices significantly. Where do you think this volume growth is coming from, and how sustainable do you think it is?
Yeah, maybe there the context that over the last few years, based on also competitive environment and pressures that we have felt in the Nigerian beer market, the actual beer prices in Nigeria are low and potentially even lowest even on the continent. And what we do as a result of that position, but also the recovery post COVID-19, is that we are trying to recover where we can. Yeah, I hope that answers the question actually, Martin.
Yes, indeed. Thank you very much, Hans. I will just move to the last question from Louise, because his other two questions have been answered in your previous answers. So this would be for Rob. FX losses were around 7 billion naira. You expect the same magnitude of losses for this year?
Thanks, Louis, for the question. It is one of the things that also keeps us occupied, of course. If you look at the reality where we are now, is that the availability of FX in this market is already extremely scarce since March 2020. So far, there are not real indications that it will improve, but there are also no big indications that it will deteriorate further. There's now roughly a gap of 40% between the official CBN rate and the rates that are used in the parallel market. Unfortunately, I cannot predict the future, so I cannot say, will it be the same, will it be less, or will it be more? In the end, it will depend on the availability of the dollars that are in this market, so the dollars that are made available by allocation from the CBN. So I think that captures your question, Sade.
Thank you very much, Rob. So I'm now moving to Adedayo Ayeni of Absa Securities, and her question, or his or her question, which I will address to you, Rob, is not sure if I missed this. What is the expected total spend on the Ama Brewery expansion? And I'm going to quickly add a question to that. What was your excise expense to gross revenue ratio in full year 21? What was expense to gross revenue ratio in full year 2021?
Okay. The first one about the AMA expansion. So if you look at the financial statement, there are now two places where you can find back the impact of AMA in the 2021 results. The first one is in work in progress, where you can find in the plant and machineries an increase of 44 billion. That does not only include AMA, by the way, but that's the increase that is there. And if you and then the other one is the capital commitments not contracted, that increased by 32 billion. Where if you break down the 44, that's one element, and the other element is plant and machinery in transit 12 billion. So the exact size of the investment in AMA we cannot disclose at this moment, because that is a forward-looking number that we do not like to share. However, what I can say is that the investment will really help increase our footprint in the market significantly, and will have a significant impact in our ability to serve volumes to our consumers.
Thank you very much, Rob. I'm going to move quickly to another set of questions from Adedayo that are quite significant, and I will address these to you, Hans. What is driving the outlook for improved consumer spending on beer and other items? Is the pricing environment better now than about 18 to 24 months ago? Do you think?
Well, to answer the question, yes. As a result, and I think that was mentioned also in the presentation. So the formal market, formal economy and economic indicators do not really present the full picture of what's happening in Nigeria. The informal market is a very significant driver of increased demand that we are seeing not only in beer but across fast-moving consumer goods companies. And that is, if you want, a phenomenon that we have seen from sort of mid COVID-19, so somewhere late summer, early autumn 2020, we started to see this happening. And to your question on pricing, we are, as a company, recovering. And I think if you look at our longer term trajectory, what we try to do is protect our margins, and we dare take inflation as the main indicator, and we're trying to stay also longer term below, and that is and will remain the objective in our pricing strategy moving forward. Thank you.
Thank you, Hans. As a quick build on that question, do you think competition is more rational with price increases now, given the material cost pressure in the last 12 to 24 months?
We will have to leave that to the competitor, obviously. But speaking for ourselves, it is clear that the very significant volatility in the market and the enormous, there's maybe no other word for it than enormous increases, unprecedented increases we see in raw and pack materials, but also in transportation, in fuel, anything we touch will logically, as a business, lead to increases that we try also to be as respectful as we can for Nigerian consumers, but it's clear that we have to move in line with the distorted, if you want, value chain that we see across the planet at this moment in time. And the expectation is there not that things will get lighter. Looking at what's happening now in the Ukraine, the oil prices that are moving to, what is it today, $105. So this is and will be and remain a constant factor in the way we manage our business moving forward.
Thank you very much, Hans. I'm going to move quickly to take the questions from Olufisayo Ademilua, and this will go to you, Rob. Her first question, what drove the 1.47 percentage point contraction of the cost to sales ratio in full year 21. And I'll quickly add the next question onto that, which is what percentage of your debt is Forex denominated? And what percentage of your raw materials is locally sourced? Where do you source your FX? At what rate do you source it?
Okay, and thanks for these questions. Some of them are not that easy, to be fair. So let's start with the first one. This contraction, it depends a bit, of course, on the definition that you use on the cost to sales ratio. So I will assume that I am taking my view on that. If you look at the way that costs develop during the year, the way that our business works is that we try to get yearly contracts, at least yearly contracts, so yearly fixed prices with our suppliers on our main raw and pack materials. And then during the year, of course, we have to finance them and have to pay them. And during 2021, it was later in the year a little bit of roller coaster that the input cost went up more. If you then look on the other side on our revenue development, the bigger price increases that we did, we announced that those were the ones that we announced in September and in late October. And that resulted that the impact of those price increases becomes much more visible in 2022 numbers. So I think what you refer to is a short-term effect on the 2021 full year view versus only the effective part of the price increase late in the year. The other part of our, what the question was, the percentage of debt denominated in FX. So we don't have any foreign denominated loans in this company. It is part of the way that we want to operate. We only want to operate with local borrowings, not with foreign denominated borrowings or anything like that. So of course we have a growth in the payables linked to the fact that we are sourced for certain materials from abroad. So I hope that answers the question. And the last one, which percentage of the materials was sourced locally? If you look at the way that we work, we try to source as much as possible what is available locally to get that locally. Also because that takes away on the short term the FX element of the transaction. If you look at the main raw materials, we use a significant sorghum in our production of brewing of our products, and to a lesser extent malt, more for the premium end of our portfolio. So the sorghum part is a local sourced element, and I think that is one of the bigger ones. If you look at the packaging materials, in principle, we source almost everything there locally. However, at the back end, our suppliers, for example, our can suppliers needs to buy aluminium coil that they source from abroad, and that part for them is in dollar denominated. So I hope that answers your question.
Thank you very much, Rob, for those thorough answers. The next set of questions will go to Hans, and I will take the last question from Olufisayo and a related question from Chima. So the last question from Olufisayo, Hans, is there a propensity to enter the spirit market in 2022? And I will also take a related question from Chima Ukadike, and he asks, Heineken has started its plan to intentionally expand beyond beer. And we see this with the deal with spirits maker Distell in South Africa. Is this something that we should expect from NB in the near future, given the current realities in that market in Nigeria, in the market in Nigeria, and the growing trend of spirits consumption? Those two questions for you, please, Hans.
Yeah,
Thank you.
Let me try to answer that in slightly broader context. Nigerian Breweries has been in the Nigerian beer market for now over 75 years, and our success is very much related to adaptability. We have always been, and we will continue to be, a consumer-centric business, and with changing demand, we will continue to develop different propositions that cater towards these changing consumer needs. If you specifically zoom into Beyond Beer, it is clear that Nigerian Breweries has already ventured decades ago beyond beer with malt, with our proud Maltina and Amstel Malta brands, but also with stout, with energy drinks, with soft drinks like Ferrous. So we have a very significant beyond beer portfolio as we speak. And what we try to determine for ourselves, and this is where the right to win comes in, how can we further expand our portfolio beyond beer, but whilst doing this in a credible way. Now, it is clear that Heineken has or is in the process of acquiring Distell, which for us, is noted. We obviously read newspapers like you do and are informed about the transaction. That is all we, for now, know. And as and when we will be informed, if at all, by Heineken, and we will take it from there. In the meantime, the Beyond Beer portfolio, and that is also mentioned in our presentation, will become, we believe, an even more important part of our portfolio. From mainstream lager, as I alluded to earlier, we see consumers moving away, different taste profiles, the mention from earlier, quality over quantity, so premium versus mainstream. So we will see a more differentiated market moving forward that leads also to complexities that we feel we are very well positioned to take advantage of. But it is clear that the Beyond Beer agenda is very much at the forefront of our strategy discussion moving forward. Thank you.
Thank you very much, Hans. We are coming to the end of our Q&A session, and we only have room to take one last question. And we will take this question from Aminat Ogunbola. And her question, which I will address to you, Rob, is: during the year, the company derecognized a substantial amount of right-of-use assets due to renegotiated agreements with vendors. What impact does this derecognition have on distribution channels?
Okay, so thanks for this question. If you look at the build-up of our income statement of how we did it when we had the right of use of assets in place, so under IFRS 16, it led to the reporting of different elements of the distribution cost over different line items. So part of it was in financing costs, part was in administrative expenses, part was in distribution costs. If you, after this derecognition, it will all move to the expense by nature line distribution costs. So that will increase. And I think the easiest way to deduct that backwards is look at the build-up of our P&L items, where you can see where the different elements has dropped, and they have been disclosed in the financial statement, and then you can properly assess exactly how that will impact the distribution costs going forward.
Thank you very much, Rob. We have come to the end of the Q&A session, and I would like to thank you both for the presentation and also the detailed answers to the very extensive and detailed questions. We had a flurry of questions across all of our business operations, and I would like to thank the participants for all your questions and apologize that we don't have enough time to take all of your questions. And we would invite you to please send them directly to our invitation address, where we will still do our best to answer them to every extent possible. At this point, I would now like to invite our Company Secretary and Legal Director, Mr. Weboy Adebaku, to give a short note of thanks and to also close the meeting. Thank you very much.
Thank you very much. Thank you very much, Shade. I think you've actually done the vote of thanks. Once again, everybody, thank you for joining us. Thank you for participating. We've been able to, I trust that we've been able to give you some insight into our performance in 2021, as well as the results that followed the performance. And we've also give you insight as to how we see the year 2022, which is already in the month of February. We just say thank you for your continuing interest in our company, in our business. And thank you once again for your participation. We hope to see you some other time. Bye-bye, everyone.
Thank you. Bye-bye.
Thank you and bye-bye.
Bye.
Bye-bye.
Bye.
Shout out to the ones where they run things. Behind the scene, they know they see you. You they walk, you they try, you they make sure say everything